Hello, everyone. My name is Rushi Shah, and I am VP of Product Management here at YCharts. And I'm really excited to be joined by Nick Maggiulli, the Chief Operating Officer at Ritholtz Wealth Management. Nick, how are you doing today?
Doing great. As I said, just got back from Future Proof. It was an exciting time out there. Your guys' booth, just want to say, was just crowded with so many people. I've never seen it so crowded. So, hey, but the conference is bigger and glad things are going well and great to see you guys out there. So we had some fun.
Yeah, thanks, Nick. It was great seeing all of you too, and thank you for joining today. For those of you that don't know Nick well, Nick is, like I mentioned, COO at Ritholtz Wealth, but he's also the writer of a very popular blog called Of Dollars and Data. So, Nick, thank you for joining us today. We're excited to talk to you about the housing market and get through some great data and visuals with you. Just a few housekeeping items before we kick things off. So, if you have any questions during the webinar, there is a Q&A section in the Zoom link or the Zoom area. So go ahead and throw those questions in there. And also, please keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. I'd also like to point out that a recording of this webinar will be emailed to everyone afterwards. So if you want to go back and review anything that we talked about today, feel free to find that replay that we'll send to you, and it'll also be available on our YouTube channel. All right, so with that, let's kick things off. Today, we are talking housing data. So we're going to go through a few things, including challenges in the housing market. Big week last week with the rate cut, and we're excited to show some things about the data there and what it means for housing, real estate, and all sorts of things. Then we're also going to go through just some portfolio information and market shocks and what that can cause for your portfolio. And if you're an advisor, how you should turn market volatility into client success. So a lot of good stuff. And like I mentioned, throw those questions in there and we'll try and hit those throughout the webinar. So Nick, let's set the stage and talk about challenges in the housing market. I just have a simple chart up here. It's the 30-year mortgage rate since the great financial crisis. How do we get here? What's going on in this chart? What can you tell us about mortgage rates since the GFC?
I mean, yeah, since the GFC, you can obviously see that the mortgage rates came down, as housing was collapsing to try and stimulate demand. Fed dropped rates to zero, and they stayed that way for basically a very long time. And then 2022 happened, and it all kind of reversed basically, and very quickly you can see that. And everyone knows this already. There's nothing new here, but just the speed at which the rate cuts I'm sorry, rate cuts rate increases happened was as said, I don't need to say this word, but I'm going to say it, unprecedented at the time. But the last time we had rate increases like this was the late 70s, early 80s. And so we've had have something like this, but not at this rate. And so I think that's what's caused everything, because of how quickly it happened, and consumers and investors didn't have a ton of time to react to it. So that's where, and they've since come down with the, obviously there's a 50 bips cut last week. And so now 30-year mortgage rate is sitting around 6% from a high of, as you can see here, 7.8%, probably a little bit over a year ago, I think it was. So it's quite a drastic change, even over the last year, still dropping, 2% basically.
Yeah, definitely. And I think the really interesting thing over the last few years is just consumer psychology behind real estate. You hear people talk about how hard it is to find houses or how quickly things sell, but also you hear people talking about the troubles in the housing market. How do you think about consumer psychology with these quick moves in mortgage rates over the last few years?
I mean, everyone's anchoring to kind of recency bias. And so, like, everyone, if you're in the market for a house now, you probably know someone who has, or you have someone in your network that has a rate of, 3% or 3.5%, or even low. I know people with 2.75% mortgages, which is bonkers, but I know people who bought in 2020 and things like that, and who got these really low rates. And so you're thinking like, okay, well, maybe I'm not going to get that, but I'm going to wait until I can get something close to that. Maybe I can wait until I get 4.5. Maybe I'll wait till 4%. And so people are thinking that rates are going to come down, and we know they've already started to come down. And so people are thinking, oh, this if I just wait it out and then it'll come down enough, then I'll buy. So I think there's a lot of pent up demand waiting there. And there's a lot of people that maybe want to sell, maybe want to get a different place, and they aren't willing to do that when rates are at 7.8%, but maybe they're willing to do it when they're at 5% or 6%. And so that's kind of the big conversation, because both sides of the equation are affected by the rates, right? So there's not a lot of houses selling because not a lot of people are putting it on the market because they don't want to have to get another mortgage at, a rate of 6 or 7%. So maybe they're waiting for a lower rate as well. So this is both sides of the market will start to interact more as rates come down. So
Yeah, that's great. And you do a great job with this visual here. Oops, sorry. Um, with this one here on just the overall mortgage payment. So this is more of a personal finance thing when a consumer is looking at their monthly statement and they're looking at how much they're going to have to pay monthly for their mortgage. That's when this rate really matters, right? So what can you tell us about the consumer when looking at it in this way?
yeah, so yeah, everyone focuses on payments. That's a very important part here. And what this chart is showing is, assuming you bought the median priced home in the US, you put 20% down, you finance the other 80% with a 30-year fixed rate mortgage. What would your mortgage payment have been? So this includes this line here takes into account two pieces of information. What's the price of housing, right, for the median home? And then also what's the interest rate? So as interest rate goes up, the payment will need to go up, right? So it calculates basically like the mortgage rate using, a financial calculator basically. And it says, okay, in 2020, you could have got the median priced home and 30-year fix for $1,000 a month, right? After putting 20% down. Today, it's closer to, $2,000, $2,200 a month, right? And so it's basically doubled, within a few years. And most of that happened, obviously, as you can see, in 2022, but literally within the span of 3 years, the price doubled. Like the price of housing for a new house is basically doubled within the US, which is, I mean, that's crazy, because overall inflation hasn't doubled, right, as a whole. I mean, it's definitely up, but like everything else in the economy has not doubled in price, but housing has. And that's a big indicator of what's going on here.
So yeah, just to like reiterate what you just said, it's almost like a double impact from not only the median house going up, but also the rates going up at the same time. It caused this increase to be a lot more exacerbated than just normal inflation, right?
Yeah, exactly. And so like I think housing's up, I think just pricing is up like 40 or 50% as a whole. But because rates have gone up so much, that's, it's like a multiplier that's multiplied higher. So to be basically 100%. So I would say it's roughly half each. I haven't actually done the math on that, but that's my guess. It's half of it's coming from rates and half of it's coming from actual prices. So
Yeah, super interesting. What can you tell us here about the price to income ratio and again, thinking about the consumer and how their income has changed over the last few years, but how that's also impacted their home prices in general?
yeah, so incomes have gone up slightly since the beginning of COVID. I mean, I think the median, they say overall it's flat, but it depends where you look. But the problem is like housing is just, as you saw, just doubled. Like housing is basically doubled, but but income hasn't. And so you're seeing like record, price to income ratios right now in terms of like, so, what you need to do to buy a house, it's just so much more expensive than it's ever been for like the typical person in the United States. So I think that is more indicative. Once again, it's about the mortgage payment. It's about how much you're taking home. And so I think that's more indicative of the problems that are going on right now in the housing market.
Yeah, and it'll be really interesting to see what happens here once these mortgage rates come down, inflation comes down, and all of that put together, right?
Yeah, and hopefully, I mean, what prices are going to do, there's a big debate, because obviously, as more buyers come in, as rates come in, or as rates go down, that's going to increase prices. But technically, there's also should be more supply as well. And so, which one's going to win out is going to determine where prices go, basically. And so, we will see. I think I mean, I would hope there's more people willing to sell that want to get out, and that'll drop prices a lot more than the demand, and because we need prices to come down to make it more affordable. But we will have to wait and see.
Definitely, definitely. And so I think, when we've had previous conversations about this, Nick, you've really spelled it down into this simple equation. Can you talk through this and how that supply and demand kind of plays together to leading up to where we've gotten to today?
I mean, yeah, there's two things. Like, I always think about like, okay, people that are unable to move, and then people who are unwilling to move. So if you don't have a high enough income, you can't afford a house because prices went up, you're unable to like buy a house, even if you wanted to, right? That's a certain portion of the population. And then there's the people who are in a home and they want to move, they maybe want to do something else, but they have a low rate mortgage or they have no mortgage at all. And they're like, why am I going to go out and trade my 3% mortgage for a 7% mortgage? Or why am I going to take no mortgage? My house is paid off and trade that for a 7% mortgage. I'm not going to, and maybe they'll do it for a 6%. Maybe they don't even want to do it for a 6% mortgage, right? So those are the trade-offs. So you have people who are unable to move, and then you have people who are unwilling to move. So on both sides of the equation, it's making, it's reducing sales. And it is very clear in the data. Like sales have dropped, home sales have dropped in a very large way. And I think we're going to see that coming up here. So
Yeah, and you talk about the data, and that's exactly what we have right here, which is the existing home sales, right? Existing home sales have fallen 39% since the beginning of 2022. What are your thoughts here? Where does this go from here with the change in the dynamic of the markets in general?
yeah, so I think if rates have, let's assume rates have kind of peaked already and now they're on the way down. I'm not going to try and predict the future of rates, but as we assume rates don't go back to 7.8% or anything like that, I think we're going to see this start to kick back up. So I think this is close to bottoming at some point because, I mean, we should be pretty close to that as of now. The only way that this would, I mean, if prices keep going up and keeps people out of the market, but then that should, if prices are like the market's naturally adjusting for all this stuff, right? So like if prices keep going up, that means there's a lot of demand, and so like you would expect more people to sell even given rates coming down. So I would expect this to increase though. I would be shocked if this is, negative 50% a year from now. If it's even worse, I would be absolutely shocked. I think we're going to see a lot more activity now as rates start to drop. And as they continue to drop and it becomes easier for people to borrow, I think we're going to see this kick back upward.
Definitely. And we did see some data come in on mortgage originations last week or data from last week after the Fed dropped rates 50 basis points. But again, going back to the last few years, this overall chart showing how many mortgage originations have happened in the last few years, it's almost at lows since the 2000s. So really what you're saying is you'd expect this originations chart to spike up as well with those mortgage rates coming down, right?
Yeah, I don't know I don't know how quickly it's going to move up, but I would expect this to move upward, right? I would think there's going to be some, resurgence here. I don't know if it's going to be like some of these vertical lines we see here, but I don't think we're going to see this bottom like it did in what it looks like maybe Q1 2011. I'm trying to guess where that bottom is in the low over there. But yeah, I'm thinking we've seen the bottom, I would hope, in mortgage applications and existing home sales, the declines there. And we'll have to see from there.
And is there a target mortgage rate or a target interest rate that could kind of spell this originations chart to really take off? Is there like a threshold or a certain rate that psychologically people are potentially looking at to say, hey, this is a time for me to either refinance if my rate's higher, or potentially this is a time to purchase a new home and have to start a new mortgage?
I have no idea. I mean, my guess is, I'm just trying to do this based off like people use heuristics and it's like 5% is probably like, okay, 5% is like a little high, but I could deal with that. I think 7.8% is crazy to some people. Like I couldn't do that, but some people obviously did. Some people are going to see 6% and be like, that's still a little high. We know they're going to cut more. I'll just wait it out. And so I think that's kind of the behavior that's going on is people are just kind of doing a wait and see. There's also a lot of talk about where's the recession? Why hasn't it happened yet? Maybe people are saying now it's going to happen next year. They just keep kicking the goalposts forward for the recession. So they're like, I'll wait till the recession and then I'll buy because it'll be easier. And I don't know. So there's a lot of debates going on, but I would say, yeah, if I had to pick a number, I would say 5% seems like a number where people a lot of people, okay, we're at 4 point something percent, 4.75%. I'm in, right? I can imagine people borrowing at that level.
Definitely. So just summarize this all for us, Nick. How did we get here? What does all this mean for housing in general and the data that we just looked at?
I mean, so yeah, if you think about it, there's like four parts here. COVID happened. There was a lot of demand to kind of move into housing and say, hey, why am I in the city doing this? A lot of people moved to suburbs or moved back home and then they bought a home, right? So there was higher demand that increased prices. And now that prices are starting to move up, then rates moved up at the same time, which led to obviously higher mortgage payments. And then when you have higher mortgage payments and higher rates, that leads to less demand, and then less demand leads to fewer sales. So it was just everything just happened in such a way such that it was like the perfect storm of kind of killing the mortgage market off temporarily. And so I don't think that's going to stay like this forever. Obviously, now with rates coming down, that's starting to offset this, but that's kind of the playbook of what happened, right? Demand led to prices, prices and rates led to payments. Payments, obviously, higher payments means less demand, and then that's leading to fewer sales. And we've seen that in the data. It's very clear.
Yeah, for sure. And the data is super interesting, and the supply and demand dynamic is as well. So before we look at this visual, I did want to go into YCharts and just pull up a housing dashboard I have. By the way, if you're a YCharts user on the call, you can access this in our templates. If you're not, feel free to start a trial and check out this housing dashboard. It's great to just see all sorts of data that we just talked about. There it is. So things like mortgage rates, mortgage originations, um, home prices, all sorts of things. So I want to just click on this chart here. And we talked about since the great financial crisis, but I think, Nick, you had some good comments about just psychology about mortgage rates. And if you really go back to, let's see, our data goes back to like the 1970s. What does this kind of show you in terms of that mortgage data and the fact that this tells a totally different picture, maybe, than someone looking at the last 10 or so years and that
Yeah.
recency bias?
Yeah, that's exactly it. Like recency bias, it rules us all. And so if you grew up in an era, I don't know, say grow up, I'll just say like, I was an adult from, let's say, I graduated college 2012. I've only seen low rates. So when you look at this chart, like that's like the aberration. That's the outlier. Like I grew up in the outlier era, and like the normal era is kind of like what we're in now. Like 6% for mortgages, like that's very normal. And you talk to people that are older, like, yeah, that's very normal. And they saw this other outlier on the upside, which is, very high, but like a 6% mortgage would not have shocked people, 40 years ago. But today it seems shocking because we just went through, as you see, the low there is 2.65. So knowing people that got 2.75 mortgages, which is a very real thing, or people that refinanced around that time, this is a very real thing that happened. And so yeah, I think I would just say like this is normal. Like the rates we have today are very normal, and if they feel high because of the recency bias, but relative to history, like they're actually quite normal. 6% for a mortgage is not outrageous, I think, But once again, we're biased by what we know recently, and we're like, oh, I know people with 2.65 mortgages. I'm not gonna pay 6%. You feel you're getting ripped off, right? And so that's where we're at.
Definitely. And then when you zoom in and let's just look at like the last 3 years, you could see you mentioned how quickly we've moved down from that high, which looks like it came in around October of 2023. How quickly does this continue to move down? Do you think it follows interest rates or where the Fed funds rate is pretty closely, or how correlated is that, or what can we expect as the Fed continues to decrease rates?
I would think it's going to follow pretty closely. Of course, like even since they cut like rates, they said some rates have come back up a little. So I think it generally follows. Of course, like if something crazy happens in the market where people are like, the Fed sets a rate as like a, kind of like a floor price, but obviously like other things that can happen that could send rates back upward, right? Like, so it's all about risk and what risks are happening. And if there's a recession and all sorts of things that can happen that can send these rates in a different direction. Let's assume none of those bad things happen, and I would think they would follow the Fed funds rate. I mean, correlated with the Fed's fund rate over time. So
That makes sense. And with those rates, you sent us this visual that looks at just overall lower mortgage rates and what that means for purchase applications. What does this chart tell you about where we are in the market?
well, yeah, I mean, it's just you can see they're obviously inversely correlated, right? Rates go up, applications come down. My mother was a loan processor, and she's been doing that since I think 2002, 2003. She worked through the countrywide stuff. She was at everything the GFC. She kept her job despite all the craziness going on. She worked through that. But this finally, like this was the point once 2022 happened, rates went up, and applications fell off a cliff, and she can't do that anymore. She's no longer in the industry. But this is a case where this is how bad it is because rates have gone so high so quickly that people have just stopped buying. And so because of that, this is a very unique period, right? And so obviously now that rates are starting to come back down, I would expect applications to come up. We haven't seen as much of a bounce back yet. I think people are doing, once again, wait and see. Like, why would I buy now at 6% when I'm pretty confident it'll probably be 5.5 in a few months, or it might be 5% in 8 months, so everyone's kind of doing that wait and see. Everyone wants to buy the bottom, right? Everyone's trying to get a deal, right? No one wants like, oh, you're going to do the first cut. And when we're expecting 2 or 3 more cuts this year, like, no, you'll wait, right? So especially if it's not urgent, you'll wait. And so I think that's what's going on here. So I think once that last cut happens, or we're getting closer to the last cut, I think we're going to really see this take off. How it takes off and in which way, it's hard to predict though. So
Yeah, definitely that'll be interesting. And I think what's really interesting about using YCharts and some of the data we have and some of the stuff that you've posted about is there you can look deeper into the data and get even additional insights. And you did a great job here talking about mortgage ready consumers. I won't give away the punchline here. I'll let you talk through this. What is this um, visual tell you about how consumers are thinking about different home prices?
yeah, so this is a little bit older, but when as mortgage rates were going up, there was this I can't remember who put this together, but basically this shows the number of mortgage ready consumers who could potentially qualify for a mortgage based on the different mortgage, like the size of the mortgage. So 200,000 at the top, then 300, then 400, 500, 600, right? So obviously the larger the mortgage, the fewer people that can qualify it. That's all that's showing. But what also is showing is that as rates drop, more people can qualify. And so let's just look at a $300,000 mortgage here, the green line here. I just want to focus on that. If you just see from 6%, when mortgage rates go from 6% to 5%, the number of qualified borrowers goes from 25 million almost to like 28 or 29 million. So you're talking about 3 to 4 million more people would be qualified as rates drop. And so when they drop from 7.8 to 6, more people are becoming qualified. That means they're able to do this. Whether they're going to, that's a little bit of behavioral psychology. Are they waiting for more rate drops or rate cuts? Who knows? But this is a fact of life. Like, as this keeps dropping, more and more people will be qualified for a mortgage. And some people right now are priced out, and as rates drop, they will not be priced out. So we're going to see that change, and that's going to start happening. So I think this is one of the most important charts here to think about. Like, as you're speaking with clients, as you're thinking about, okay, well, what should we do? Should I buy now? It's like, you could, but also what's everyone doing? They're waiting for more. They want more rate decreases. Of course, you could buy now and then just refi later. And so, I mean, I know we're going to be talking about refis a little bit later, but just last week, refi activity was up 20% week over week from the year from the week before, and it's up 175% from a year ago, because guess what? Rates have come down and people are like, yeah, let's refi. And the first rate cut, they're ready to do it, right? And you can do it I mean, there's no real limit, but there's usually, they say, 6 months seasoning you have to wait in between rate cuts to kind of refinance. But yeah, we'll have to wait and see what happens. But I think people are going to say, hey, let's just do it, and then I can refi later. And that's always an option.
And it's fair to say, if you're a financial advisor, you're probably going to get these types of questions more often, right? If there's more people willing or looking at the housing market or waiting to make that real estate decision, they might come to their financial advisor to ask some of those questions, right?
Yeah, exactly. Like, I'm doing the same thing. Like, I would love to get a place eventually, but like, I'm just rolling treasuries and just waiting. But now the treasuries aren't paying as much. So it's a slow process of like going through this and just waiting and kind of waiting to see what happens. So yeah, I feel like I'm in a similar position as others who are just kind of, they want rates to be lower. It's kind of crazy paying, 7.5% when, you ideally you want below 5, even below 4 if you can, so we'll see.
Definitely. Can you talk us through this chart? And I think the big thing that we should be focusing on here is net worth, right? So if you're an advisor thinking about your client base and people at different stages of their life or different net worths, the real estate market is impacting them differently. So what does this visual tell us about that?
Yeah, I love this. This comes from Visual Capitalist, so shout out to them. But this shows, within each net worth tier. So on the y-axis there, you have, 10K, people from 10 to 100K, people from, 100K to a million, et cetera. Each one of these different, net worth tiers. This shows the breakdown of their assets, right? So like, how are their assets broken out? How much do they have in, let's say, liquid cash as a percentage of their total versus a primary residence versus vehicles, et cetera. And the thing I want to focus on is the primary residence there in kind of that orangish red color. Because that's showing that, like, for certain households in the United States, certain net worth tiers, housing is a very, very big deal. Like, as you can see, for the billionaires, 100 millionaires, it's a small fraction of their net worth. They don't really care. Oh, my house went down $1 million, who cares, right? But for most Americans, it's actually a very sizable percentage. And, if you look here, this is showing, I think with the 100K to a million tier, it's like 50% of their assets on average are in their home, right? Which is it's a large amount, right? And so keeping that in mind, because, a lot of people, it depends, a lot of people will look at housing and say, well, how's that affecting the average American? Well, that's their piggy bank. That's their biggest asset, right? So even though they can't take that money out of that piggy bank, one day that will be passed on to someone else, the heirs of those individuals, and that's where a lot of wealth transfer happens. So it is something to keep in mind and to watch. And so, yeah, that's why I think this is important, is to understand, well, who's this impacting the most? It's impacting, lower middle class to middle class Americans, I'd say, and even upper middle class Americans as well. You see that even that 1 million net worth tier, like it's a pretty sizable part of someone's net worth there.
Yeah, definitely. And it's something that is probably much more on their mind because it's such a sizable part, right? It's a big part of their decision making and the held away assets that they have away from a financial advisor. It's a much larger portion of that for those people in those net worth tiers.
Yeah, and this was 2022 data, so I would assume since prices have maybe gone up slightly since then, I would expect these tiers even be a little bit larger within these. But I don't know. It's kind of tough to know because also stocks went up, so maybe it's offsetting it a little bit. But yeah, I would expect it to be somewhat larger.
Definitely. Let's bring inflation into the picture a little bit. This is just the real housing index since 1890. What does this chart tell you, Nick?
Yeah, so for most of, US history, housing has basically kind of kept pace with inflation. It hasn't, gone up too much. It hasn't, it's had periods where there's been deflation and it's gone down. There's periods when it's gone up a little bit, but for the most part, if you look over a very long time series, it's like basically net flat. And then only, in the late 90s, really, it just took off in a way. And of course, you're like, oh, well, that was just the, GFC, that was the housing bubble. But even since, we bottomed and now it's taken back off right again. So we're seeing that housing is moving in a way that it's never moved before. And it's such a different asset class than it was before the year 2000. And we're seeing that breakdown. And so the question is, should it behave this way, or should it behave like how it behaved from the year 1900 to 2000? And so if this is going like this, then it's clear, like, if housing actually should be behaving like how it used to behave, then we're clearly in a massive bubble. And there's people that argue that. I'm not sure that that's the case. I could see that maybe housing is becoming a different type of asset, but there's arguments to be made on both sides. And maybe that straight vertical line is what that's obviously a little concerning, but maybe the total growth rate, the average growth rate is just higher. Maybe there's like a change in the step function that's happened. And so we should see a higher average growth rate, but maybe it's not this, it's kind of more like this, right? So yeah.
Yeah,
That's what I think of when I see something like this. Like, either there's been a fundamental change in housing in the US, or this is a massive bubble, and people have made arguments on both sides. And that's where a lot of these debates are being had.
Yeah, definitely. These couple visuals talk about the consumer a little bit deeper. Not only, we not only have housing data, we have data on personal savings rate, consumer credit outstanding, retail sales, consumer sentiment. I think when you talk about this potential of a bubble, people might compare where we are today to the great financial crisis, where some of these data points looked very different. How are you looking at this data and where the consumer's balance sheet is compared to other time periods that had some housing volatility or some housing surprises like we do today?
I think the consumer balance sheet is much better today than it was in 2007, 2000, like 2006, 2007, right? I don't think we're seeing that level of I don't know if the words overconsumption or overextension maybe going on, but yeah, I think even savings rates are low today, like, but they were just very high. So like, I feel like there's this, if you look at like, oh yeah, our savings rate today is 3.3%, but yeah, it was just super high because of COVID. So like, people are spending to offset it. But if we do a rolling average, it won't look as bad, right? So that's one thing to keep in mind. And I just think, like, yes, credit outstanding is higher, but if you look at incomes are even, like, as a percentage of income, it's not as bad. And so, the US still has a lot of wealth. I think we're in a much better place than we were in '07. So even if housing were to crash a little, I don't think we're going to see the same type of destruction, financial destruction that we saw in '08. So yes, of course, recessions can happen, bad things can happen, but I am nowhere near concerned to the same degree as I would have been in 2007. If I was 17 at the time, I didn't know what I was doing, but if seeing the same data today with what I know today, yeah, I wouldn't be as concerned today. So
Yeah, definitely. And like you mentioned, some of this data during COVID or the pandemic, it's just kind of breaks these charts, right? Or these lines. But if you kind of look past it or look before it, I can give you a little bit more indication of normal environments that you can compare and contrast to.
yeah, exactly. But at the same time, you saw U.S. Consumer sentiment is low because of inflation. I think that's mostly that because that data there's very little inflation in that series, but the first time you have inflation, people just don't like rising prices. And so that's most of it. Like people like, oh, well, sentiment's low. Yeah, sentiment's low because you go to the grocery store and certain things are much more expensive than you remember. And even if your income's higher or, okay, people, US, most households don't even spend that much on groceries as a total percentage of their budget. So it's not like even if prices went up 50%, you'll go from like whatever 8 or 10% of your budget to, to 15%, which don't get me wrong, that sucks, but like, it's an annoyance, and that's where I think it's getting to people psychologically more than it's actually like bankrupting people because they can't afford, grapes or something. Like that's not what's happening here. It's very annoying, and it's yeah, I think that's more of the case here with the consumer sentiment.
Definitely. That makes sense. All right. Well, let's shift a little bit and talk about portfolios and how real estate fits into portfolios, but also for the financial advisors on the call, how does this lead to questions and thoughts about asset allocation and things like that? So let's go into before we go into YCharts, let's look at this chart real quick. And I wanted to kind of set the stage for the asset class conversation. This chart has home prices versus the S&P 500, and it has the drawdowns of both. How do you look at this chart? How do you kind of allow this to help you make decisions on where a consumer should think about their asset class breakdown of all of their assets?
When I see this, it's housing just moves so much more slowly than a lot of the securities out there. In this case, the S&P 500. It's just prices move so much more slowly, right? Like S&P 500 bottomed within probably 6, 7 months, right? It was probably, if you're counting like the high was technically in '07, but let's just say we're counting from when the drawdown started really in '08. And, within 6 months, we were at March '09, we were at the bottom already and then started to rebound. Housing took multiple years to bottom, right? So there's that first difference. Second thing too, it's like it won't decline as much because there's a host of reasons why. One thing is like people aren't always getting the price of their house. Like you're not quoted your price. There's that, the Buffett analogy, Mr. Market, that's giving you the price. You can check the price of your stocks every day. Price of your house, you're just doing based on comparables, what you think. But like the fact is, if everyone tried to sell their house at once, yeah, prices would more likely move more quickly and reflect kind of how they do, like how assets do, or I'm sorry, securities do. But because they don't, a lot of people just sit on them. They don't do anything. Prices are much slower, and they don't, we don't see this price discovery as quickly. So those are the two things. And so when you're thinking about your overall asset allocation, like housing is something that's definitely less risky than stocks. At least has been historically. I have no clue the future. People buying houses now may be, may not see a positive return for who knows how long. I have no clue, right? It's tough to know. But just generally, if we say general volatility, I wouldn't say like long-term risk is unknown, but short-term, the volatility is obviously much higher in stocks. And so when you're thinking about like how you're setting up your allocation, think of it like that. It is obviously it's an asset, but it's also a consumption asset. It's a very weird type of thing because it's a consumption good, but it's also an investment. But once again, you can't eat your equity necessarily. So it's very weird. I try to mostly look at it as a consumption good. But I do think people should consider it in their portfolios because it is something that is not going to fluctuate as wildly as your stocks, your retirement account, anything like that.
Definitely. And there is some data around not only prices, but things like housing inventory that you can look at and gauge how much you should potentially invest into the housing market. So does this chart kind of help you with that at all, or does this tell you anything in terms of that asset allocation decision?
I mean, I don't put too much into like macroeconomic indicators personally. I mean, it is obviously housing starts came down because like rates went up, people weren't buying as much. And there is some concern that we're not building enough, but like there's a lot of regulations and there's a lot of other things that are going on that are maybe suppressing that. But I think this is kind of a wait and see thing. I don't try to put too much stock into what's going on with, housing inventories and things like that. Of course, like if you're a builder, if you're someone that's like very invested in that, like if housing starts to creep back up, that's maybe good for real estate, but it depends. It really depends kind of if you're a builder, that's good. But if you own a lot of housing, like imagine we were just looking at housing starts in Austin, Texas, and you're like, oh wow, I own a lot of property here. And then they start building a lot of property. Well, that's bad for you actually, right? So depends where you are in the equation, where you are in the ecosystem, determines whether housing starts and inventories are good or bad for you. If you're an investor, if you're a consumer, etc.
Makes sense. Um, this other data point too is the U.S. housing market index. So maybe this tells you a little bit more on just housing in general. Would you say this is indicative of the housing market, or how do you look at this data point?
Yeah, I mean, when I'm looking at this, like obviously, like this index has fallen off quite a bit, and so that's that's not a good thing. But maybe it's starting to normalize a little. Like you can see, there's like this up and down that's going on very recently. And so yeah, it's very difficult to determine. I'm not exactly sure what this means next. I mean, I'm on a wait and see basis right now because I think we have to wait and see what rates do, and that's going to determine a lot of activity, whether we've bottomed or not. So
Makes sense. Yeah, if you're a technical analyst, it almost looks like a channel here at the end, right?
yeah, it's looks like we're in a range there.
Yep, yep. All right. Well, let's go into YCharts and look at a few things here. And I think within the tool, we already talked about this housing dashboard and all the economic data that we have. Let's look at a client portfolio. So I'm just going to go to, let's just say you have John Smith as your client, and you're looking at their asset class breakdown. Uh, there's a lot of data here. You can build a portfolio and compare and contrast the asset class breakdown to something you want to get them to. But I think the challenge here, Nick, is you don't really have that housing equation all the time, or how much they have in their house, because it's could be a held away asset or something that you don't have visibility in. So if you're a financial advisor talking to a client, how do you include that in the conversation of how they are allocated?
I mean, there's different ways of doing it. As you said, some say, "Hey, let's look at this purely as consumption." And once again, this is a philosophical discussion more than it is like an implementation discussion. It's like some would say, "Let's hold it away. It's a consumption asset. Let's not even count it as something you can sell because even if you sell your home, okay, then you have to rent, and now that's more expense you have to take off, or you have to go buy another home, right?" So it's like whatever that asset is, it's not like you can quote eat it in the same way unless you're like, "Oh, I'm going to sell here in California or in a more expensive place and then move to a very cheap place." That's the only way you really kind of realize some of that equity. So some people just hold it away. You can add it in here. You can add it in as like you can put in like a REIT or something and just say, hey, this like REIT allocation will be considered your house. Obviously, that REIT is going to move a lot more though than your house price probably will. So there's trade-offs of doing this. There's no, real way to put in a house. I guess you could create a custom security in YCharts and put in some value and say, hey, this is what and every once a quarter, once a year, you put in the Zillow estimated value. Like there's ways of doing this, but like they all kind of get back to the same thing of like, well, what does that really matter? How is that affecting my portfolio just in general? And so I don't like thinking about I prefer to look at it as a consumption good where I can, but there's definitely ways to add it in.
Yeah, and I think within YCharts, there's a lot of great tools and functionalities to at least let you have that conversation without needing that part of the data, right? So if I go into the stress test tab, for example, I'm able to talk through, hey, what happened during the GFC to your portfolio, and let's talk about what happened to your house as well, right? Or what happened in the last or in 2022 during the inflation drawdown. So there's a lot of things you could do here from a stress test perspective to talk through those situations to really help answer that question of what's going on with the interest rates.
Yeah, and I think once again, like the thing that people really care more about is the economy than even what's going on with their portfolios. Like, because during, obviously the GFC, like, yes, it's bad, your portfolio is down, whatever, 42%. But the question is, like, did you lose your job? Do you have to support someone else in your family? Like, all those things are the things that are probably going to impact you more than your portfolio value being down. And don't get me wrong, like that matters too, but I think a lot of people realize like, oh wow, there's a lot more going on here, and that's going to impact you far more, right? If you lose your income source, that's more of an emergency than like, oh, my portfolio is down 25%. Like that's most of the portfolio stuff is future consumption anyways, whether you're going to consume it or you're going to pass it on to someone else who eventually consumes it. It's not something that's immediately needed right now. So that's kind of my counter when I think about this is like at the end of the day, what really matters is the economic impacts and how that impacts you like day to day. And for most people, that's their job and their income.
Definitely. Another tool I know you love, Nick, is our scenarios tool. So I wanted to pop in there and try and talk through for the fact that advisors are probably going to get more questions about housing. I have this saved scenario here, and it basically is just a typical saving for retirement conversation. So we have a start date of 2010 and date of 2024. Let's just say your client had $1 million and they're assessing their retirement withdrawal. So let's just put that in like the S&P 500 so that they can plan for what the next 14, 15 years could look like. And what we're looking at here, this is without buying a house. If that's the question they're asking you, you could see the end result of investing in the S&P 500. I know this is kind of a biased time frame because the market has pretty much gone up the last 15 or so years, but you're seeing that end value, you're seeing that withdrawal amount, and this really helps you with that conversation about, hey, what's the plan here? What does the future look like? How else would you use this scenario tool to have that conversation?
Yeah, I would obviously, you're using what looks like a 4% annual withdrawal. You would try maybe using different scenarios there. Like, hey, what if we did a 3%? What if we did a 5%? What does that look like? Um, obviously there's other things you can do, like with the retirement date. Maybe they're not going to retire and maybe they'll start pulling from the retirement instead of 2017, they'll do 2018, or maybe they'll do it earlier. So there's all sorts of dates and rates changes you can make here. Those are the ones that come to mind just immediately, right? That's the top of mind stuff. But there's definitely a lot more you could do here.
Yeah, one thing I think is really cool is I could add in hey, let's say you bought a house, right? Let's say you bought a house and that's technically a withdrawal because if you're pulling it out of your portfolio to purchase that property, and let's say it was for $400,000 or something like that, you could put that whole scenario right in here, right? And I can go ahead and say, this is a one-time withdrawal. We're going to do it on maybe like 12/31/2013, like 3 years out. You add that in there and you can really see the impact of what does this mean for my annual withdrawals that I can actually take, and how does that set me up for retirement, right? So this is a great use case for if you're getting that housing question of, hey, should I take money out of my portfolio? Well, let's talk about the impact of that to your client.
Yeah, and I think the best part here is you can just, write down and compare the distribution amounts, right? So if before it was 70,000, now it's 50,000. Okay, well, that delta of 20,000, whatever it is, okay, could I pay rent and do that? Like obviously you have to predict the future. It's very difficult, right? To know future rental rates, things like that. Like, is that worth it or is it not? And so thinking about that kind of more holistically and saying like, how does this impact my plan? How does this impact what I could do with my money? I think is incredibly helpful to kind of have these types of things. And also you can be like, hey, I might get an inheritance. You can do the other side where you have a plus asset instead of a negative asset here in this case. And then you can run both of them, and which I think is very useful for planning purposes.
Yeah, definitely. And all this is, you can put it into a PDF report and share it, right? So right here we have a PDF breakdown of, here's John Smith's portfolio. Here's maybe a balanced benchmark that you want to compare it to. Here's return values. This is something an advisor can put in front of their client and say, hey, let's talk about your portfolio, not only from a performance and risk perspective, but from an asset class perspective, and really tie that into some of these interest rate and real estate conversations that people are having.
Yeah, especially like if you know like, oh, hey, when rates go up, we know that impacts, or when rates go down, we know that helps growth stocks generally more than value stocks, right? And you can show that there's all sorts of different things you can say related to that. But yeah, I completely agree. I think it's nice to kind of have these proposals where you can it really just allows you to kind of ask questions and walk and see where your client's head's at, because they're not gonna 90% of this they're not going to care about, but the 10% they do care about, they care about a lot, right? And so it's like figuring out where's your client, what are they thinking about when they're looking at this stuff, when they're trying to make these decisions, and that's where you're kind of add your value as an advisor. And so this is kind of like the big menu, the big array of everything, and then figuring out, okay, well, where are we actually going to drill down, and kind of figuring out how to have that conversation.
Yeah, definitely. All right. Well, I think that's all we wanted to cover. But Nick, I do see a question in here about mortgages, and the question was, or I'll read the whole thing. It says 6% mortgages aren't high to history, but prices have risen much faster. So 6% today is probably significantly more than 30 years ago. How are home prices reconciled? Do we just need a whole lot more of relatively non-existent supply?
Yep, I think that's probably the answer. It's obviously not a great answer, but it's probably true. I mean, there's only, you need to build more housing. It's just the nature of it. The problem is, I mean, one of the issues is, if housing represents, let's say, 50, anywhere between 30 to let's say 60% of a typical household's net worth, right? Just like within the United States, and you start building a lot of housing, then guess what? That a big piece of your net worth starts shrinking because it's worth less because there's now more of these houses, right? So more supply lowers prices. I don't think there's any debate there. We're seeing this happen right now in Austin, Texas. They're like the quote poster child for build a lot of houses and watch prices drop, right? And so that's exactly what's happening. And so there are going to be coalitions of NIMBYs, as we will call them, not in my backyard, who will say, hey, we shouldn't build more supply. Here's why. And they'll have all their arguments for it one way or another. But it is to protect prices. It is a price protection game. And I'm saying this as a non-homeowner. I'm saying like, hey, like, yeah, we should build more houses. But yeah, I bet if 70% of my net worth was related to housing, I would probably be at those meetings too. Like, I'm going to be honest. Like, a lot of people will say, oh, no, I want to build more housing. But like, until it's you, you may not say that. And there's a very few people who will say we need to build more housing and have a lot of their net worth in housing. So that's one thing to keep in mind. So.
Makes sense. Makes sense. All right, Nick. Well, I think that's it here. I did want to point out again that that dashboard we covered on the webinar, the housing one, it can be in your account. Just go to the dashboard templates. If you have any questions, reach out to your support contact. They can help you get that dashboard added and get all this great data in your account. Additionally, feel free to start a free trial. We have 20% off if you mention Nick Maggiulli. So definitely sign up, mention Nick's name, and we'll get you a good price for YCharts to get all those great visuals and all the great data that you need for all these housing conversations. It's a crazy time right now and an interesting one for sure. And that's it, Nick. I think we can wrap up here. Thank you everyone for joining today. This was great. Thanks a lot, Nick, for all your insights. It was super valuable.
Yeah, thank you. Thank you everyone for joining. Appreciate your time. And thank you, Rushi. Thank you, YCharts. And by the way, if anyone has questions, housing questions, feel free to DM me on Twitter or Instagram or LinkedIn, wherever I am. I'm happy to chat. All right. Thank you,
Sounds
everyone.
great. Thank you, Nick. Take care.